Right, my name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that offers traders access to the Forex market, but also energies, metals, indices, and binary options. This is a strategy session. We do this every Friday here at fxstreet.com, 7:30 in the morning. Good to have you. I've been doing webinars at FX Street for 10 years. Quite a trend, huh? So let's reestablish the mission of the webinar. What is the primary goal for doing these webinars? My goal is for you to make an extra 1,000 pips. I want you to know and believe and feel that by attending these webinars, somewhere, somehow, at some point in time, you've made an extra 1,000 pips. Is anyone making any progress now that we've been doing these webinars for, 20 weeks or something? How are we doing as far as your knowledge or your success? How have these webinars helped? Could you provide some feedback? Igor's still struggling? Okay, let's try to find out why. Really better than before? That's a start. Good. Pan on fire definitely gives you a sense of direction. Very good. Anybody having better control over their trading? Because that means to have control, you have sort of plan versus just firing off a bunch of trades, right? Pan on fire says, yes, we've been giving up on pound yen, but you should probably not be trading pound yen until you have, proven success on other currencies. Just too much volatility. Or you drop your lot size and triple your stop and then see how you do. Okay. Well, I would rather you start with a trade plan that's flawed than just trade. Okay. So did anyone do very well, let's say yesterday, after the Draghi news? Yeah? Mike says no. Okay. What were you doing? Buying euro? Right. What would go wrong? Euro USD drops, 250 pips. Like, how do you not make money? Got out too early? Okay. Yeah, when the news came out, one of the things I looked at was the monthly pivots. There was one at 111, I guess. That was sort of the bottom end of the range, if you look on the daily chart anyways. Yeah, so it seems to have missed the move because you tightened your stop loss. But, it fell for 5 hours. There must be an opportunity to get back in, no? I mean, I'm not criticizing. I just want to know where your weaknesses are so we could address that. Right? Like, for example, the euro dollar fell. Well, yeah. I mean, yeah. Isn't it supposed to? I mean, that's the long-term fundamental bias, right? And for the last 3 or 4 weeks when the euro dollar's been going up, I've been showing people every single Monday that no one was buying the euro. No one. If you look at the commitment to traders report, no one has bought the euro. No one. There are no large institutional positions long euro. So the only way that euro dollar goes up, and I think we talked about this a lot last week, so I don't have to revisit it. Well, let me actually confirm it. Is that something we talked about last week? That the euro dollar was going up and up and up, but no one was buying it? And some people struggled with the idea. Well, how could it go up? Okay. Yeah, that was like the whole point of last Friday, right? So now, fast forward, and look what happens when the bears get back in. Okay. Mike, by the way, you're sending me private messages. Please send it publicly. But Mike says privately that he seems not be at the right place at the right time. Then you need to drop your your leverage, right, your lot size, significantly. And I would like you to focus on swing trading, not anything shorter than an hourly chart. Yeah. Well, of course you don't have confidence. Why would you have confidence, Mike? Right? I don't know if you grew up in America, but in the 70s, people were taught that they should be rich and famous because mommy had to go to work, so they put little baby Wayne in front of the TV, and and the kid watches TV and realizes that they need to be a confident, successful, rich, good-looking person, and through divine intervention, it's going to happen, right? Mike's born in 61. So that probably fits right in there well, Mike. But anyways, you couldn't possibly be confident unless you were successful. Okay. Well, so Mike says he trades small time frames to avoid big losses. All right. Well, that's not working. So let's try something else. Lots of people are saying that they can't see the chat messages. All right. So I don't know what to do. Yeah. Well, sorry. So we need to find something that works better for you. And when you're doing fundamentals, for example, ECB is in the process of quantitative easing. The whole topic on the up for discussion is when will they increase quantitative easing? Okay, you see what I mean? And the Fed is not doing quantitative easing, and the thought process is sometime soon they're going to raise interest rates. There's a divergence in central banking policy. Those two questions are there, and they're obvious. I mean, they're so unbelievably obvious. It's the only thing being talked about. When will quantitative easing increase at the ECB? And when will the Fed raise interest rates? Now, they're big question marks, and we can debate them, but that's the sentiment. That's what's influencing sentiment in the market. For the Euro USD to fall is just, it's just absolutely no-brainer. So you don't want to miss those as a currency trader. Because if you don't have your thumb on that pulse, then you're missing what everyone's talking about. It's sort of like not being invited to the party. So we want to make sure all of that's on your radar screen. And if you're on a longer-term trade, so what is this, USD CAD? Oh, but I wanted to make a comment. Did you guys see that China just cut their RRR and their interest rates? They did that at just before the webinar started. Yeah, Sebastian says Aussie spiked. CAD spiked a lot more, as you can see here. So the question is, are you going to sell it? That's just your okay. Um, Euro USD. So maybe having, if the short term, you said before that you don't seem to be at the right place at the right time. Well, that's a timing issue. So let's try to remove the timing issue from the equation as much as possible. So here's a swing trade from earlier this week. I guess this is what I did on Monday. Okay. Remember? Lower low. What's the key word, guys? Felipe, why did Kiwi and Aussie? Yeah, that's their commodity currencies. Yeah. Yeah, everyone's like hammock. Yeah. Well, I got two subjects going on, so let's go back to okay. China cuts interest rates and the reserve requirement ratio. Okay. And that is accommodative. That can increase money supply. Okay. And that could be good for the Chinese economy. It could be a catalyst for growth in China, which could be good for if that does take effect, that could be good for commodity producing countries. That's why Kiwi would move. That's why Aussie would move. That's why CAD would move. Brazil should move, so on and so forth. Again, straight up, Forex Trading 101. So that came out just at 7:15. Now, the actual cuts take effect on the 24th, I guess, so starting tomorrow. They cut the one-year lending rate, but more importantly, they cut the RRR, the reserve requirement ratio. Okay. So anyways, this is what we did on Monday. Or Tuesday. You know what? This was probably Tuesday, wasn't it? Tuesday, I'm sorry. This is what we did on Tuesday. Yeah, Pat now knows what that means. Isn't that awesome? Yeah. Up and then down. Pretty simple plan, right? Let's see. Looking at it from a different point of view, here's the range that we're in. Top of the range being pretty well defined. Guess I can bring this down a little bit. Okay. And bottom of the range pretty well defined. Now currently we're in here, and that's reasonable support as well, isn't it? But you can see we already have that planned out. We already have the breakout planned out here. Okay? It's interesting, right? The difference is I'm apparently more bearish than the market. So I thought maybe we would have a little breakdown here. But there was just a pause. We were just not ready. We needed to get through that. And then we're going to find out that the Fed doesn't want to raise interest rates, and so that's going to be a problem too, isn't it? So Sebastian says, "How can you lose money if you're a euro bear?" Yeah, well, but we all know timing is the issue, isn't it? Okay, so Mike kept seeing that the euro would rally short term. Right. So you're not doing your fundamental analysis. You're only looking at technicals. And so I've been showing people every Monday for about a month that the euro, and it was the whole topic of last Friday, Mike, euro USD was going up, but no one was buying it. So the thought process was, when euro USD gets back to resistance, bears may re-enter the market, but there are no bulls. Okay, so you got to get that thought process under control. So if you're a bear, as long as you're below resistance, there's no reason to be a bull. When you look at the commitment of traders report, it shows you there's no large institutional investors buying. So how could the Euro USD go up if nobody is buying euro? The answer is those that were short were getting out of the short positions. And at some point, whether it's this resistance or maybe a different resistance, but at some point at resistance, those bears are likely to re-enter unless we do see a change in the commitment of traders report. Mark has a question. Do you see that we will have the next 2 months till the Fed December? So what could happen is that the dollar could weaken until we get to the December meeting and the Fed raises interest rates. But the thing is, maybe that's already priced in. Or we want to price that in now, where we're like, you know what, who cares about October? No chance of them doing it in October, but we do believe December's on play. And they just... So I can't tell you when the dollar bulls will front run, but half the equation has been laid out for us. You know, the ECB would like to do some additional quantitative easing. So half the equations come together. Now, I think last week we talked about a perfect storm, didn't we? Can anyone confirm that? Where we talked about the perfect storm brewing, where the ECB adds quantitative easing, which is additional accommodation, and the Fed does the opposite, raises interest rates, and you get this perfect storm. Well, this would be an example of that slowly coming together. This is half of the storm. Okay. Now, I believe another one that we've been talking about have been the yens. Has anyone done very well in the last, 3 weeks on the yens? I've done a lot of training on how to get into some of these trades when the market was still technically bearish, but turning bullish. Right? How many people have seen those discussions? I think we had one on Aussie where Aussie was the market was still technically bearish. Okay, you can see I don't know, I'm missing half of my thing, but okay. So the discussion was, how do you buy it off support when it's still technically bearish? Is that familiar now? So when you look at the chart this way, and we were just sort of triple bottoming, nothing bullish on this chart at that time. So we had a psych level on Aussie dollar. This is Aussie yen. Aussie dollar. It sounds like a bad joke, but we had a double bottom at 69. It sounds like a dirty old man joke, but we had a double bottom at 69 on Aussie dollar. And so, what if Aussie goes up from there? What if that's as low as it's going to go for now? So on Aussie yen, see, here's to revisit this discussion. If you think Aussie dollar is going to go up, but you don't want to sell the US dollar, when you bring it around the other way, wouldn't you rather sell the Japanese yen? So that was our discussion, all right? So is the stage set? Aussie dollar at a psych level, presumably as low as it's going to go for now. So you want to buy Aussie, but you don't want to sell US dollar because you're fundamentally bullish on the dollar because of the potential for the Fed sooner or later to raise interest rates. So you want to go long Aussie, but you can't do it against the dollar. So that begs the question, what would you want to buy Aussie dollar versus? All right, well then let's look at Aussie yen. Aussie yen triple bottoming. At the same time, we got that bottom forming on Aussie dollar. We're forming the same bottom on Aussie yen. However, the market is still technically bearish. How do you get in this trade without being a degenerate gambler? And we talked about hedging this with binary options. And you can still see I have the word cash here and option. All right, so I was talking about shorting basically being short the derivative, but long the cash. And the reason for being long the cash is you have unlimited upside and you're collecting an interest payment 7 days a week. Right? You remember this conversation now, ladies and germs? I mean, I'm not sure if you're getting this training anywhere else. I don't really know. But I think that's pretty cool stuff where we're talking about using derivatives to reduce your risk by 40% so that you could trade this Aussie yen like a professional trader would. So this one, we reduced your risk by 40% and got you long in something that you might fundamentally want to be long, but the market is technically bearish. And so since then, we've gone from 83 to 88.5. So, so we're at 88 now. So that's 500 pips towards your 1,000 pips this year that I'm trying to get you. And that was, it took hours to put that together, right? Or not hours. We talked about it for 30 minutes, I'd say at least. Nice to see the follow through, though, isn't it? Now, can anyone see the follow-up trade? What's the pattern that you should be recognizing here? It's a pattern that I've told people that if you were going to start with just one pattern, you could probably form a career trading this one pattern. Double bottom followed by what? Double bottom followed by a higher high. YJ nailed that because this is what YJ did. We had him focus on that, I don't know, 2 years ago, YJ? I guess maybe 3 years ago. Well, you did it for 3 months, but it might have been 3 years ago. I can't quite remember. Yeah. And so I had YJ, I said, we want to do this for 100 days. All I'd like you to do is on all time frames, on all currency pairs, I just want you to hunt for one pattern. All right? Like this double or triple bottom is support followed by a higher high, or the opposite. A double top at resistance followed by a lower low. Okay? You guys following me? Pretty easy to spot, isn't it? Support a blind man can see, or resistance a blind man can see. That's all it is. We don't have to get caught up on the patterns. I really don't like people trying to memorize patterns. You remember the guy that sells you a book for $250 and it's got, 1,000 different candlestick patterns? That's like the dumbest thing ever. Right? Just what a dumb idea. Right off the bat, just even the thought of it. What a dumb idea to have to memorize 1,000 different candlestick patterns. That's how you think the world works? Really? So, no. But in this case, we are at support. It's been pretty well defined. Support, 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 support. And the key factors in trading or support and resistance. Okay? That's what's important, right? So you know what? Let's take notes here. Okay. What's the number one thing in the trading world? Long-term bias. Okay? So, let's start with that. Would you like me to give you $1 million to trade with? All right, Mike, we get it. Your trading sucks. Park your negativity at the door. Let's not worry about that. We've already defined that. Let's move on. Yeah. All right, cool. Okay, long-term bias. If I gave you $1 million, do you think it's a fair question and I say, well, what are you going to do with it? It's a fair question, right? Okay. So, yeah, run away. Move to Slovenia. All right. All right. So you got $1 million. Well, what are you going to do with it? No, but okay. I mean, that's it. I mean, it's like, I used to teach people how to raise venture capital, and the first thing I'd say, okay, well, tell me about your startup. What do you do? And they just babble out some nonsense, and I'm like, look, I don't know what you just said. I don't. Just let's talk about you talking about what you do. You know what I mean? You need like even an elevator pitch. You should be able to tell me in clearly 1 second or one sentence, let's say, what you're going to do with my $1 million. And then the next step is I should say, wow, really? Why do you think that? And then you follow that up with tons and tons and tons of support and evidence and factual data to support your hypotheses. Like, I'm going to buy US dollars with this. Okay. Well, why would you want to buy US dollars? Oh, I'm glad you asked that question. Let me give you 3 reasons. Okay? But that's your long-term bias. I don't care what it is, but you need to be able to clearly explain it to somebody. And if you can't, you don't have one. And if you don't have one, you probably won't be, and I say probably won't be successful on the long run, because on the long run, you don't know what you're doing. And you're always dependent on being right short term. And when you're only short term, you get caught up on, you can get faked out, right? You're always shopping while you're hungry, and everything eventually looks good to you, and you're buying euro because it's going up, and then it crashes, and you're like, but I'm still buying it, so then you got to flip and drop, and then it gets to support. Now you're selling, but then it flips and goes back up, and you're like, oh, you're always chasing, and you're certainly not in control, right? Okay. So anyways, long-term bias. Then what's next? What's the next most important thing in trading? Support and resistance. No, I don't care about risk management. Because if you can't enter your trade, forget about it. You don't risk management. We haven't even got there yet. It's not a bad thing to be good at risk management, but if you sell at support, you suck. I don't care what your risk management is, right? So, for example, if your long-term bias is to buy the US dollar, then you're going to sell euro dollar at resistance. Over and over and over and over. And then in periods when the euro dollar is making higher highs and higher lows, you're not doing anything, except identifying the next level of resistance in which you might want to sell. So we had a conversation yesterday about someone that was bearish on the euro dollar, but was selling it in a up market. I'm like, well, what are you doing that for? Well, I'm bearish. Yeah, but the market's bullish. Who told you to sell a bullish rallying market? Is it working for you? No, I'm losing money. Well, then stop it. Right? Captain Obvious, but sometimes you need to be, slapped in the face. Like, what are you doing? It's bullish. I thought you were bearish. Yeah, I'm bearish. I'm selling. You're selling a rising market. And then I asked the person, like, how much money do you think it takes to reverse the Euro USD? 200, 300, 400 billion dollars today, now, right? Do you have $400 billion in your trading account? No. Then you should probably wait for the market to return to its bearish nature and then sell. Right? You see the difference? Sell in a falling market, not sell in a rising market. Okay, so anyway, so if you know you're a bear, you sell at resistance. If you know you're a bull, you buy at support. And, and obviously you're doing that when the market is trading and trending in the direction of your long-term bias. The downside to this is if the short-term technical market is up, but your long-term, let's say fundamental or technical bias is down, you might go 3 or 4 or 5 or 10 days without trading. Right? You might have to go 10 days without trading. But that's 10 days without losing money. And for most people, that's a good start, isn't it? When was the last time you went 10 days without losing money in Forex? Well, the 10 days you went on vacation, right? So anyways, once you have that established, then you get to things like your trading, right? Short-term technicals. Whoa! Oh, snap. Look how important that one was. Why was that jumbo? Who told it to be jumbo? Did I tell it to be jumbo? Okay, I don't know what it should be then. 18? A little better. And then, you know what? I'll do the risk management part. But the funny thing about risk management is it's easy. But I'll throw it in there. A couple people said it. How could I not agree that, risk management is important, right? So I'll throw that in as number 4. But, that's so far away from most people, right? Why are we worried about risk management when you sell at support and buy at resistance? So, right? Like, that's so far off, it doesn't matter. But, it is an issue. So, like, I've been watching a scalper the last year or so. The guy's like 95% success rate, and I would never invest in him. And I don't think he's got a long-term bias. So it's all support and resistance and short-term technicals, and no risk management capabilities at all. And the reason he's wins 95% of the time and has almost doubled his account this year, I would never invest because of the risk management. So it's important. Okay? So that's how I'd line things up. And everything else is just noise. Oh, Alexander says why why I would never invest into someone like that? Because if he's wrong one trade, he won't make any money for the entire month. Well, in this case, Black Cat, he won't blow up his trading account. It would take multiple trades to do it. But when you, I don't know, whatever. It just, look, I just wouldn't give him my money. That's it. I can do whatever I want with my money. I certainly wouldn't give it to him. All right. So anyways, so that's how I put that together. So fundamentally, I do want to be long Aussie yen, mostly want to be short yen. So we got the double bottom or triple bottom, then the higher high. And then now that it's the higher high off of the support a blind man can see, I simply fib and catch the retracement. That's it. Just ridiculously easy. That's it. See? That's all it is. Retracement. Where? Off of here. This is the same stuff we do over and over and over again. Every day, day after day after day, I do this stuff for you guys, right? That means it's repeatable. Oops. So that's the good news, right? So we set this up in a bearish market. Oh, I killed that longer term move. Let me add that back. All right. Okay. I mean, we did this, you and I, live, and you're starting to see the move. Well, that's only 500 pips. Oh, I know. Now, remember, the insurance policy that we bought on this to reduce our risk cost us 40 pips. So you're only up 460 pips, to be frank. But it's a start. And if we can get some follow-through, it will continue. Okay, but to get in the marked area. All right, so how do you get into this, right? Okay, long-term bias, up, fine. Support and resistance, support, support, support. Short-term technicals, right? Breakout, retracement, whatever you want to do in here. Inverse head and shoulders, whatever you want to do in here. All right, that's like a week worth of trading in here. Makes the higher high, fine. And then what do you do in here, right? Where do you buy it? This is where you drop into like your 15-minute chart or your hourly chart. Okay, and you look for patterns. Again, double bottom, buy low. Remember, if you're a bull, you're not really paying attention to the resistance. You're just looking for support and reversal patterns and all that kind of stuff. All right. Now we have a higher high. So should we do this? We already had that, though. Right? So on and so forth. Pin bar, engulfing candles, 5-8 crosses, oscillator crosses, anything. At some point you have to recognize that it's not going down, it's going up. So there's 1,000 ways to trade this. Look, there's the higher high, right? I mean, there's just so many ways to trade this. Which one? Pin bars and engulfing candles and oscillator crosses, moving average crosses. Yeah, any of it. Just do it. I don't care about that. That will be part of number 3, and I guess number 3 is gone now, short-term technical bias. But so what is important? A, long-term bias, that you want this to go up, and then you've recognized it's reversed and decided to go up. That's what's important. 2, where are you now? Well, see, if you're a bull, I want you to identify the next 2 or 3 levels of support in which you might want to buy. Okay? Might want to buy. You might be up here, but you say, you know what? I might want to buy if we can get a 3A2 Fibonacci retracement off this roll reversal area. That sounds intelligent to me. So you wait. Price comes down. Hits your 3A2 in the roll reversal area. What do you want to do, son? You want to buy it. You know that. You've been waiting for it for days. Now it's down here. How do you want to do this? I don't even care what your answer is anymore. I don't care what you do in here, as long as you said you wanted to buy, if you get some sort of thing. If you're looking for a pin bar, if you're looking for a bullish engulfing candle, if you're looking for a 5A cross, if you're looking for an oscillator move, yeah. See, at that point, it doesn't matter if you use a ADX or CCI. It doesn't matter at this point. You're at support, trading in an uptrend in the direction of your long-term bias. I don't care what makes you pull the trigger. Just pull the trigger. And if you're wrong, you know you're wrong because you'll lose money and you'll take a small loss and it'll fall to the next level of support. Because remember, I said find me, 2 or 3 levels of support in which you might want to buy. Well, there's a cluster of something going on here of weekly and monthly pivot points. It's also a 50%, right? Or maybe you buy it down here, monthly central pivot point, weekly pivot point cluster, and you try it down in there. Okay? So to me, the pulling the trigger, you use any technique, they'll all work. Why? Because you're buying at support in an uptrend in the direction of your fundamental bias. So choose your poison after that. Honestly, I couldn't care less. And you'll probably be successful most of the time. And you'll know when you're wrong because you're losing money. It's pretty easy. Okay? And then how do you manage your target is the next question. Well, what was your strategy? I don't know. Right? How long do you want to be in the trade? Why did you get in the trade? What market conditions do we have currently? What is the market sentiment? Is there news coming up this week, this day? Every time that's different. But again, that depends on why you did it. Okay? Now, I might say that I'd like to be in this for a very long time. I could say to you, I don't think the RBA is going to cut interest rates any further. In fact, interest rates at the banking level have already started to go up. Does everybody know that? The 2 major banks in Australia have already raised interest rates? Well, I could say, I think we've bottomed out on the Aussie dollar. That could be my opinion. And I say, well, I might want to be in this for a very long time. 2 years, maybe. Where did you get this info? I'm just awesome like that. I begged people to read the RBA meeting minutes. Did anybody do that? Yeah, and Commonwealth was the other one, guys. Okay, good. Right on. So I could argue that. That would be part of my sellable idea on long-term bias, right? I could say, you know what? I've been reading the RBA minutes, and I've been watching interest rates at the banking level in Australia, and I believe the Aussie dollar is bottomed out, and yet we still have a 2% carry. I'd like to be long Aussie dollar with your million for at least the next 2 years. And if I can do that and keep my stop managed at break even on all those trades, I'll be able to guarantee you 200% on all that money that I have invested into the Aussie dollar, because I will be collecting a 2% yield on the leveraged money. So with your 1 million, I could actually buy 100 million Aussie dollars over the course of time and collect 2% on the 100 million. but you only have 1 million invested, so that would be a 200% return on investment, and we haven't even started to talk about the pips. Give me your money. Number two, I could say at the end of October, on October 30th, there's a potential for the Bank of Japan to increase the rate that they are doing quantitative easing. Okay? You see what I mean? That could be very good. Now, more information has come to light over the last few weeks. It shows that that is less likely to happen. It still could happen. Now, if the Bank of Japan on the 30th comes out and says there's no way in hell we're going to even think about adding more quantitative easing, the yen will get strong, this will come down, maybe I get knocked out at break even. Boo-hoo. Cry me a river, cry me a river. Right? So all of this would affect how long I want to be in this trade. If the Bank of Japan says there's no way in hell we're going to do more quantitative easing, and I'm still long and I have like 300 pips profit on this trade, maybe I just take my profit and reevaluate. Take a break while the yen is strong. Try again another day. Does that make sense to everybody, both sides of the equation? And why I would do Aussie yen but not do Aussie dollar and all this kind of stuff? Is it well thought out, thorough, detailed, logical, intelligent? That's what I want for you, baby. I want you to succeed. Yeah. Mike, maybe you want to do my fundamentals course. I don't know. Just start somewhere fresh. Just a different point of view completely. Just a thought. Yeah. Oh, you mean the euro? So let's go technicals, right? Let's go technical. Are you telling me the euro fell off the hourly 21? Right? Shocking. Let's go 21. Let's just go to a typical chart. Let's go to the hourly 21. Let me zoom in. Really? So anyways, let me ask you. Actually, let me get rid of some of this. This is old. Let me ask you something. Why do I have the 21 EMA on my chart? What is the purpose? Why is it there? What do I do with it? Because if it doesn't have a very specific meaning, then I need to get rid of it. It's a dynamic level of resistance. If price is below the 21, I'm bearish and aggressive. And when price comes back to the 21, I sell it. I sell it hard because I'm aggressive. If price is below the 21, there is no support. That is how aggressively bearish I am. There is no support. This will fall forever. So Black Cats as a reference point, more particular, a selling point. Okay? Now, the classic Wayne, like one of the first webinars at all at FX Street. Because before they started doing webinars, I actually used to do chat meetings on FX Street where I would type a chat. And one of the very first webinars ever done on FX Street is I did a PowerPoint presentation showing that I would sell a 5A cross after a touch at 21. Does anybody know that for a fact? It's called a smart plan. And the S and M in smart plan is I look at the speed of the market, which is the 2155, and the momentum of price, which is the 5.8. It's still, there is a version still at FX Street. It's a 2-hour lecture that will reinforce this idea of price in the moment it's congruent, or it has centrifugal momentum in the direction of the market that is moving quickly. In fact, it's the title of my book, Strategic and Tactical Forex Trading. This could actually be a chart in the book. So that's why I'm like, yeah, look, euro dollar's falling, but isn't it supposed to be falling? Right? You should look at a chart like this and say that there's no way in hell that you could buy it. That's how important I think it is. That there's nothing someone could do, nothing you could even see that would even make you think about going long. This whole time you're just like, I want to short again, 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 I want to short. And that's it until the 21 breaks. And then you go, whoa, 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 whoa. Something in the market now has changed. Therefore, I need to change my behavior and my expectations. That's the difference between a good trader and a great trader. They know when to change their behavior. And that's one part of it. Has anyone seen that 2-hour lecture at fxstreet.com? Oscar says, is that correct on every time frame? Yes, it is, sir. That's why it's brilliant. Because I've actually adapted my moving averages to work on multiple time frames, and you'll see it. The more you study it, all of a sudden you'll say, that's interesting. The 5 on this time frame is the 21 on that time frame. And you're like, that is such a coincidence. No, Daniel's like, so you'd enter short now? No, don't be redonkulous. You're like 3 or 4 hours late. Watch the video, Alexander. Put in the time. It's 2 hours of your life. It's on FX Street. Right? Buy my book. Read it. Do something. But I can tell you, I've been trading publicly in front of people for over 10 years, and I haven't changed my strategy at all, ever. Isn't that amazing? Like, I don't have a cool new strategy of the week. You know? So, anyways, I'm trying to simplify things, guys. The market is bearish. In here, price action is bullish. Do I sell? No. The price action now turns bearish here. And the market, as you can clearly see, is already bearish. Do I sell here? Yes. And here's the brilliance. You're selling when price is falling in a bearish market. That's not too complicated, is it? I desperately want you to trade well, guys. I want you to trade well. And if you can find success, I have money. So I want you to succeed. Maybe I'll give you some money. I want you to succeed. Well, there you go, Pele. Make sure you tell FX Street. We still have plenty of time. How else can I help, guys? What other subjects would you like me to cover today? You're the boss. I am the humble currency trader. How can I help? Indie cycles. In like indicator cycles? I'm not sure what you mean. Pound CAD? No, I don't want to look at pound CAD. Oh, thank you, moderator. I appreciate that. Any news on DAX? I'm not following DAX at the moment. What do you call it when the market is buying bonds and buying stock? Can you give me something a little more specific, Lawrence? Oh, the Mexican peso remittance strategy? Let's do that a different time, if that's all right. Trading euro pound. I just did that yesterday, I think. It's a good opportunity. I'm not going to answer that, Sarah, because that's up to your decision. Oh, okay. So, Lawrence, you're asking about buying the stock market versus buying bonds and back and forth? Yeah. All right. And then Carla says, when did you do that webinar, the 2-hour webinar? I did that 2-hour webinar 7 years ago, maybe 6, 7. 2008. There you go. Thank you, Ron. By the way, Canadian CPI negative 0.2. That's not much inflation if it's actually falling. Year over year, though, 1% inflation. So Canada's got a long ways to go. Can you explain the carry trade and well, yeah, we could do that. There's the other question about risk on, risk off. I don't know what else we got, guys, because I think I've covered a lot of these before in the past. I'll do it, but what else? Well, we got to be careful there. Oscar says sometimes the carry trade make the euro go up. Well, that might not necessarily be true. Ron Peterson, the 1034. Well, a lot of people have asked about that because I think I brought it up recently. Let me just do a quick talk about it, and then we'll discuss it later in greater detail. But let's say you wanted to make the trade for the day, your day trade. Let's talk about timing. Do you want to make it at 8 o'clock in the morning? And you think you could buy something and just hold it without any issues at 8 o'clock in the morning? No, sorry, New York time. 8 o'clock in the morning, New York time. Is that a good time to enter a trade that you think could easily just play out without any undue risk for 12 hours, let's say? No. And why not? What happens around 8 o'clock that could be potential risk? And in this case, risk is volatility, guys. No, not ding, ding, ding. Not market open. 8 o'clock in the morning, guys. What happens? Come on, there's like 120 people in the room. What happens around 8 o'clock that could create volatility? Why does this take 20 minutes? News, thank you. So there's news at 8:30, so we don't want to do that. So at 8:30, news comes out and the market's volatile for, I don't know, a half an hour or so. So can you make the trade at 9 o'clock? Or is there undue volatility around that time? What creates the undue volatility around 9 o'clock? The stock market open. So, right? So that will take place. Well, what about 10 o'clock? More news. Okay, more news. So how long does it take for the news at 10 o'clock to have its volatility and for that volatility to wane? And I say about a half an hour. And for fun, you use a Fibonacci number, 1034. So at 1034, very often could be a turning point in the market where all the undue volatility has passed, and you're probably able to enter in a trade that you can be on for a few hours, and if things go well, several hours. Because all the scariness has gone by. Now, what about days when there's no news at 10 o'clock? Or if there is news, let's say it's just completely unimportant. It won't create volatility. Yeah, so then you can enter that longer term trade at 1013. Right? Or even 9, actually take that back. Check that. If there's no news at all at 10 o'clock, then 9:55 you can enter your trade, your longer term, several hour position, your day trade. If there is news and it's not important news, and it's just sort of a blip on the map, then you want to wait till about 10:13 to 10:21. And if there's important news at 10 o'clock, then you got to wait till 10:34. And it just comes down to, when does the volatility, the news, the event-driven volatility, when does that end? And that will affect your expectation for a trade. So if you want to be in a trade for a while, the volatility is a risk usually. Especially if you're just entering a trade, right? Where you only have a 30 pip stop and then there's news at 10. Well, you might want to be cautious. Now, there's another good time to enter a trade if you're scalping. And somewhere around 9 o'clock to 9:10, 8:50 to 9:10, I like to throw down a trade in with short-term movement happening because of the stock market open. Okay. Very often the stock market open is a important point in the trading day. Like very often, if New York is the bottom for the day, it'll be the New York stock market open that creates the bottom and then skyrockets up. So if I'm going to scalp, sometimes what I'll do is I'll even follow like a 5-minute stochastic cycle and sell the cycle and jam my stop. So in a perfect world, at 9:29, I have my stop at break even. Okay? You guys get that? 9:29. And you want to try to get that because, a few times a month, it's going to make you money. But you have to be reasonably assured that, you are able to move your stop quickly. Or another way of doing that is to do like a 25 pip stop, 50 pip limit, make the trade somewhere between 850 and 910. All you're trying to do is catch the volatility on the stock market open. That's all you're trying to do. Okay? And if you're right 50% of the time, do you make money? What if you're wrong 66% of the time? Well, you break even. I mean, you're not really making money, whatever it is, but essentially you're break even, right? Are you okay with being wrong most of the time and still not losing money? Is it possible that you can be right 66% of the time? %33 of the time, you lose 25 pips. 66% of the time, you make 50 pips. Yeah. So it's another trick per se, because at 9:30 you can expect volatility, and what you want to practice is, for example, how do you line up your bias for the day in which you think the stock market's going to go up versus what the 5-minute cycle is going to tell you. So let's say we're looking at the S&P 500, and on a 5-minute chart, 20 minutes before the stock market open, you have an oscillator like this. What if you longed it and hoped it just simply went up for, well, at least 4 candles, because that's the 20 minutes until the stock market opened. And then if it did, you would be up 10 or 12 pips profit, and then maybe you jam your stop. Now you go into it with no risk. Or you simply leave the 25 pip stop, and you leave the 50 pip limit if you're doing it in pips, I guess, if you're trading a currency pair, because it doesn't have to be the S&P 500. It could be the Euro USD. Okay, so like I had a setup the other day. I think for some reason it was on this yen pair. I can't remember why. Yeah, it's still there. Hang on. Maybe it's not there. Here it is. Boom. So I was trading like this. No, was it? Hang on. I think there's a Euro USD. I think this was Euro USD at some point, although that looks pretty good. Let's just switch it out. Or maybe I did. Maybe I was trading this one. You know what? Maybe I was. All right, I thought I was shorting Euro USD, but I think on this particular case I was longing. So what I was doing is I had two charts open. They were the same time frame, obviously. I'll just move this to an hourly. And what I was doing, actually, I think it was minute for minute. What I was doing was watching the S&P 500 open and trading the USD yen, minute for minute. Yeah, Debisa, we already covered that. That happened at 7:15 and it's 8:45, so got it. Yeah. So I'll actually tend to do that. Has anyone tried that? This was a discussion on currency correlation and intermarket correlation, where I might be watching the S&P 500 in real time, but trade a currency pair. So I know from watching the correlations that if the stock market's going up, I'll probably buy USD yen and sell Euro USD. And I thought I actually had the example. Where's this one? Didn't even show up. I don't know where it was. I thought I had it. I thought I was selling Euro USD. I thought was what was going to happen when I opened this chart. Okay. And I'll put it on a 1 minute. Okay. And if the stock market's going up, I want to sell Euro USD. So I'm going to analyze my charts like I normally do. Seems good enough. Okay, and I want to watch them minute by minute, and I'll prepare my trade. You'll be surprised if this suddenly turns bullish, this will suddenly turn bearish. Okay. So Sarah will say there's a butterfly pattern on the 4-hour. Good. So you would take that into account. Okay? You would take that into account. You would say, because of the butterfly pattern, you believe it's going to go up or down, whatever you believe. And then ideally, the stock market open goes in that favor. And you say, aha, I know what it's doing, and I'm going to take it on this 1 minute or the 5 minute, right? Whatever the case may be. But it'll be part of your bias. But the interesting thing is when it comes to the stock market open, it's more about the sentiment really than about the fact, so to speak. And I think when I was doing this, I think what happened was I was bearish the stock market that day. We were below the central pivot point. The stock market opened green. For about 4 minutes, the stock market went up and up and up, and the stock market touched the central pivot point. And I immediately shorted whatever currency pair it was. I think it was USD yen. Immediately. And not because I saw something on the USD yen, but because I saw it on the S&P 500. And within 25 seconds, the USD yen caught up. I mean, that correlated, guys, within seconds, right? All of a sudden, the currency market switched because the S&P 500 rallied up in a bearish market, hitting obvious resistance, which happened to be the daily central pivot, and then the whole thing came crashing down, and the correlated currencies moved in that same direction. Okay. Well, Sarah, this is what you should do. Open up an S&P 500 chart. Look at it. Look at how it moves. Is it going up? Is it going down? And all that kind of thing. And then open up other currency pairs, like yen pairs or dollar pairs, and ask yourself, what are the similarities? Are they positively correlated or negatively correlated? Positive means if the stock market goes up, what does the yen pairs do? What do the yen pairs do when the stock market goes up? Is it the exact opposite? If the stock market goes up, do the yen pairs go down? Or if the stock market goes up, do the yen pairs tend to go up? If they go up when the stock market goes up, there's a strong positive correlation. If the yen pairs fall when the stock market falls, there's still a positive correlation. But if the stock market goes up and the yens go down, then there's a strong negative correlation, but you could still trade that, knowing that if this one goes up, the other one goes down. Okay? And the reason I don't give you an answer is because these things constantly change and you need to pay attention to it. Okay? There was a time when the stock market went up, the dollar would be weak. And then, a few years later, the stock market would go up and the dollar would be strong. This is why, or one reason, past performance is not indicative of future results. And this is why you want to look at several years of trading history when you decide to make an investment into a currency trader. Just because they've been great the last 9 months doesn't mean anything. It means they were buying dollar in a market where the dollar was strong. But it doesn't tell you if the correlation changes, do they continue to buy dollar when they should actually be selling dollar? Because a bad trader will make a lot of money for a while, and then he'll give it all the way back because the correlations changed, because the markets changed, because the fundamentals changed, but the trader didn't change his or her behavior, and they made a lot of money, then they gave it all away, and they have no idea what just happened. Yeah. Yeah, guys, why don't you consider taking my fundamental analysis course? I'm actually going to, I know I've said this before, but I'm actually going to try to record a new video today, maybe even 2, and put them up there. HTTP training.fxbootcamp.com. Just, I don't know, just a thought. Just a thought, not a sales pitch here. I don't care whether you take it or not. Yeah, no, I know, Ron. So, interesting, huh? Stock market's going up. It's pretty close, isn't it? Correlation minute by minute here. This is the same pattern as that 1 hour chart, isn't it? Isn't that funny? So anyways, thank you, moderator, for being such a wonderful host. Thank you to FX Street for yet another fabulous opportunity for us to get together as a community.